of investment. The second aspect of an investment is, what do I expect the value to do over time in terms of movement, I'll call it. Do I expect it to wobble or move a lot over time? Do I expect it to move a little bit? Or do I expect the investment to move little or not at all? Now, the fancy name for that movement is called risk or volatility. So any investment that you have will have some combination of what the returns are going to be and how much those returns will move up and down over time. So, oops, sorry about that. Today, we're only going to be talking about 3 investments. They're the most common and sensible investments I could recommend to you. They're the 3 that I have 100% of my money in. And they're the 3, as you'll hear about in a moment, that millions and millions of people have achieved financial freedom investing in. What we're not going to be talking about today are all the other crazy investments that you've heard about, but that I'm going to heartily recommend you not even think about. Things like Bitcoin, things like investing in foreign currencies, things like, oh, should I put money in gold or silver or platinum? Oh, should I buy oil or wheat futures, investing in the price of commodities? I'm telling you, forget all those. Only concentrate on these 3 things: stocks, bonds, and cash. And on each of them, I'm going to go through the same principles that we just talked about before. How much money can I expect to earn over time? And how much are those returns going to wobble?
Ruth has a question.
Yep. Yes. Go ahead.
What about real estate? Are you going to talk about that?
Excellent question. No, I'm not, but that's important enough that I should address it right now because it's a fantastic question. Again, I'm going to give you my own personal opinion, your choice to follow it or not. If it were me, and it is what I've done, the only real estate investment that I would consider is my own individual condo or house. There are a lot of people who have made a lot of money in real estate, and it can be a good investment for some, but let me tell you why I don't do it. Number one, it's very illiquid. And that's a fancy term for how quickly can I get rid of it if I need to. When you buy stocks or bonds or have cash, you can get your money literally the next day. With real estate, you have to wait till you can find a buyer. And if it's at a bad time in the market, you may be waiting a very long time. So that's one reason that I stay away from real estate. Second reason I stay away from it is that it's hard to be diversified. That's going to be a big term in today's meeting, but diversification means not having all your eggs in one basket. When you buy stocks and bonds, it's very easy to spread your money across a wide variety so you are diversified. To do that in real estate, you have to have multiple properties in multiple arenas. That requires a huge amount of money and a huge amount of management expertise, because if you're beyond just your own geographic area, who's going to manage them for you? So that's the second reason I avoid real estate. Third reason I avoid real estate is that you have to be an expert in a lot of things. You have to be an expert in property evaluation to know what you're paying for it. You have to be an expert in marketing to be able to make sure you have the right tenants. And you have to be an expert in maintenance and repair because of the inevitable things that happen to the real estate. And that maintenance and repair brings me to the fourth reason that I stay clear of real estate other than my own home. And I call this the hassle factor. When you own real estate, you have to stare the monster in the face and think of the following things that can and will happen. A tenant stops paying their rent. Now what? Or a tenant moves out and has trashed the place. Now what? A tenant is paying your rent, but you learn you have mold damage or the ceiling's flooded. Now what? For a stock and a bond in cash, don't call you at 2 o'clock in the morning with a broken toilet. So for
Or
all
a
those,
flood. Yeah, right.
yeah. So for all those reasons, I don't invest in real estate. It can be a good investment, but for me, I try to keep my life simple, and I just stick to investing in the market, not in physical property. But fantastic question. I'm glad you asked about it. But I'm a big believer in, if you choose to, in the value both emotionally and financially of owning your own place, be it a house or a condo or a farm or whatever. Does that answer your question?
Yeah, it does. Thanks.
Thanks. Okay, so remember I talked about the push-pull on investing. There's the return part and there's the wobbly part in the price. We're going to go through each of those for each of the investments. So this chart's a really long chart. It's almost 100 years, 1926 to 2020. The first row is on earning money over time. How much did the particular investment earn on average? And so here's what you learn, just at a quick look. Stocks earn the most, bonds earn the medium, and cash obviously earns nothing. So the stock market return over the last almost 100 years has been over 10% a year. What does that mean in numbers? It means if you had $100 in a stock, it earned at the end of that year, you would be up to $110. Okay, that's what a 10% return means. Now, bonds have earned money as well over that period, but a lot less, only about 6% a year. So if you had money, $100 in a bond, at the end of the year, you would have $106. And cash, of course, doesn't move. If you started with 100, you have 100 left at the end. Now, based strictly on that first row in the chart, you'd say, well, gee, I should have all my money in stocks because 10% is higher than 6%, which is higher than 0. But remember, I talked about the push-pull between what you earn and how much risk you have when you do the investment. That's the second line of the chart. Notice how wide, when we say a stock has earned on average 10% a year, that doesn't mean it went up 10% each year like clockwork. It meant there were years when it was up and years when it was down. And this chart, the second line, shows the range of what those returns were. I'm sure you all remember or have heard of what happened in 2000 or 2008. In the worst year in the stock market, it was down 43%. But on the good news side, in the best year, it was up 50%. You notice the range on bonds is much narrower. The worst year in bonds has only been down 8, the best year up 45. And again, on cash, steady Eddie, no returns. So this is the first big piece of learning you have to have when you consider investments. There's always a catch, okay? And here is the catch of the trade-offs. Take a look at this bullet point. To earn a higher return, meaning in stocks, you have to accept more risk. They go up more over time, 10 versus 6, but the year-to-year moves can be more wobbly than what bonds do. If you want more certainty, meaning you don't want to have the market move as much, you should expect to earn less. That's what bonds do. And if you don't want any risk, you just put your money under your mattress and you're guaranteed that $1 worth a dollar. If that's, you're so nervous you don't want to have any risk at any period of time. I'm not here today to tell you should be all in stocks, all in bonds, or all in cash. For most people, it makes sense to have some money in each of these three things because they each have a role in what I'll call your financial toolbox. They each have a function that they will perform in your investments. And so let's talk about those. But first, what I want to do, hold on, is talk about exactly how these things work, because you've heard the term stocks and bonds, but you might not be familiar with what exactly the process is to make you money. And so let's take them one at a time. When you own a share of stock, we'll say Apple, for example, you are an owner of Apple. So I'm making up the number, but if Apple had 500 million shares of stock in Apple, like little pieces of Apple, and you bought one share in Apple, you would own 1/500 millionth of the Apple company. How do you make money on that? You make money two ways. You make money if the price of Apple goes up. So if Apple was priced at $40 and went to $100, your account would be up $60. So you'd make money, that way. The second way you make money in stocks is when they pay a dividend. And a dividend is a fancy term for when the company earns money, they rebate some of that money to us as owners or investors. And it's expressed in terms of, they call it a dividend yield. It's kind of like a savings account. So if a stock has a 2% dividend yield, I'll explain how that works. Let's say the stock is priced at $100. 2% of that is $2. And dividends are paid quarterly, 4 times a year. So you'd receive 50 cents a quarter. 50 times 4 is $2. And that's how you'd earn money. So you'd have the potential for the price of the stock to go up and the potential for a dividend. Bonds work slightly differently. When you buy a bond, you are not an owner of a company or a government. You are a lender. So you've heard about how the Treasury of the United States has issued so many $1 billion in bonds. If you buy a bond from the US government, what that means is you are lending money to the US government. Again, you can make money 2 ways on that. You make money on the interest. So just like that dividend thing I just talked about, if the bond pays 3% interest a year, you make $3 on a $100 bond. And you can also make money potentially if the bond price goes up. But bonds don't vary in price nearly as much as stock. So the bulk of the money you earn on bonds will be from interest. And of course, on the cash side, if any of you has a savings or checking account now, you know you're making pretty much zero on any money you have in a checking or savings account. Now let's talk about how they work as the tool in your toolbox.
Hey, Bruce.
Yep.
And
Yes.
maybe you're going to get to this, but I'm curious with bonds, what makes a bond price go up or down?
Okay. Bond prices go up or down depending on 2 things, demand and what's going on with interest rates in general. So I'll give you an example. If the stock market plummeted tomorrow and people got freaked and wrongly sold their stock, which I'm going to encourage you not to do. But if people ran from stocks and put money in bonds, that would make the price of the bond go up and the interest rate on the bond to go down, the effective interest rate. Because look at it this way, you've asked a simple question, but it's a complicated answer. Let's use the example I said before of a $100 bond, and it's earning 3%. If the market stampeded to that bond and made the price go to $103, you're still only earning the $3. Well, $3 divided by 103 means the interest rate on the bond dropped effectively because you had to have $3 more invested to earn the same 3%. Mm-hmm. Does that make sense?
Mm-hmm.
Okay, so as interest rates move, that affects the price of the bond. But in general, the prices of bonds, although they do move, they are much more stable than stocks, as you saw from that chart I showed earlier. Okay? So back to the toolbox. Stocks are your power drill in your toolbox. They are designed for growth, right? Everybody would like to earn the 10%. So the money you put in stocks is there to really, really, really try to build your account as fast as you can over time. Bonds, because they don't move as much, they're more for steady income because that bond pays that same interest rate no matter what. So you're guaranteed to earn that 3% or whatever it is on the bond. And they're also there for stability because their price doesn't move as much. So look at it this way. If you had 100% of your money in stock, you have 100% of your money in things that move up and down a big amount. By having some of your money in bonds that's more moving like this, while the stocks are moving like this, the bond money helps the overall money that you have not move as fast. Now, remember, you won't be earning as much either because you have money in the lower interest bearing account, but the account won't wobble as much. So that's there for stability. And then finally, cash, and we're going to talk about this more in a little while. Cash is there for two things, to meet your immediate spending needs. And it's also nice to have an emergency fund that we'll talk about, where you set aside money, not in stocks, not in bonds, but in a readily available account that you could get to tomorrow if you had an emergency. So to reprise what we've just gone through, stocks are your growth tool. They move up and down more than bonds in the short term, but they'll make more money for you in the long term. Bonds are there for stability, steady, predictable interest, and they help balance the movement. And cash is there for spending and for emergencies. Remember, again, the emergency fund. If your car goes out or you have a big copay at your medical appointment that is not covered by anything, that emergency fund is there where you're not thrilled you have to pay it. It's unpleasant, but it's not a panic like, oh my gosh, where do I get the money for this? And do I have to sell my longer term stocks and bonds to pay for it? Okay, now that you have a general idea of what a stock and a bond is, we'll get a little deeper into the two different ways you can invest in stocks and bonds. The first way is the way you've all heard about, where you have a neighbor or a friend, oh yes, I bought Apple, or oh yeah, I bought Tesla. That's called buying individual stocks or bonds, right? You pick the individual ones you're going to buy. I am not recommending that at all. And you'll hear about why in a moment. But I'm recommending that you buy, instead of trying to pick individual stocks, you buy a basket of stocks and bonds called a mutual fund. And a mutual fund is simply a group of stocks or bonds. So when you have a stock mutual fund, it's a basket of stocks. A bond mutual fund is a basket of bonds. And when you own a share of that basket, it works just like the way you earn money on an individual stock or bond. Meaning, if that basket of stocks goes up in price or pays a dividend, you get money that way. And if a bond goes up in price or pays interest, you make money that way. So they work identically. The only thing is you are buying a group of stocks and bonds, not individual ones. Why is that important? Well, remember, we keep talking about what you're going to earn and what your volatility is. Most people, including stock professionals, can't consistently pick stocks that are going to outperform the overall basket of stocks I'm talking about. You may think you can, but unless you're an expert, you can't. And so don't even try. So for most people, they are better off going with the basket than thinking they're going to outsmart the market. Second, I'm sure you've all heard the phrase, don't put all your eggs in one basket, right? Well, I've used the basket analogy here intentionally. By having your money split over a big range of stocks, you reduce the risk that any single stock is going to kill your portfolio. I will give you a very sad example from a colleague friend of mine. He worked for Sprint, and Sprint's a great company, and he had all of his money in Sprint stock. Well, the market melted down, and he lost 73% of his money, because even a company as supposedly great as Sprint can have bad things happen. And he had to leave retirement and go back to work because focusing all his money in one thing wiped him out. And so don't think, oh, well, Apple's a sure better Tesla. Don't think that way. It's much, much, much safer to have investing spread out across a wide variety of investments, which is why I put my money where my mouth is. 100% of my money is in mutual funds, not individual stocks or bonds. Here's another reason to do it. Don't just do it because I'm suggesting it to you. I'm assuming you've all heard of Warren Buffett. He's one of the most successful investors in all time. And he made his money, and his company made his money by him picking individual companies, what I'm telling you not to do. He realizes that other people can't do that. And if you go online, you can read about this. He has recommended to his wife that when he dies, that she not to do what he does, but that she puts all her money in a simple mutual fund like we're going to be talking about in a minute. And lastly, happily, millions and millions of people have done what I'm recommending to you today. This is the proven way to make money. And I'm going to encourage you, ignore all the other noise. Like I said, Bitcoin, gold, any of those other things. Put your money where the good odds are, which is if everybody in America who's made money over the last umpty-ump decades has done it this way, that is a much sure bet and a much better way to financial freedom than taking a flyer on these latest harebrained investment schemes that you hear about.
That's a question.
Yes, sure. Go ahead.
I'm wondering if there are different types of mutual funds. Like, can you choose the types of investments you're making still? Like, say I wanted to invest in green companies or something
Yes.
like that.
Fantastic question, Ruth. The short answer is yes. We're going to be talking about later about the very specific mutual funds I recommend and why I would not recommend doing a narrower group like what you were talking about. But hold that thought. It's a fantastic question and we will get to it. Okay. One other kind of strategic thing to think about, whether you're investing in stocks, bonds, or whatever, I want you to memorize this phrase and proudly proclaim that you are one. You want to be what is called a buy and hold investor, not someone who jumps in and out of the market and thinks they can time the market. Why is that important? Because the market is going to have inevitable ups and downs. Remember, I showed you that chart with what the wobbles have been over time. If you're like people who don't follow that advice, they do the exact wrong thing. Here's what they do. The market drops, they panic, and they sell, okay? Then they're paralyzed on the sideline because they don't know if the market's gonna go up, if it's gonna go down, when it's gonna go up or down. And so the market starts going back up like it always has over 100 years, and they still don't buy, and they still don't buy, and they still don't buy. And then they finally buy. And so what have they done? They've done the exact opposite of what you'd want to do. They've sold at the bottom and they've bought at the top. Nobody's supposed to do that. The point is, you never know when the market is going to be up or down, which is what this second point is on the chart. This is a startling statistic. I want you, please remember this. Over half of the return in the stock market occurs just 3 or 4 days a year. And here's the little secret. Nobody knows when those 3 or 4 days are going to be. So if you think you're going to jump in and jump out and whatever, you have zero chance of hitting those 3 or 4 days. The only way to hit those 3 or 4 days is to be a buy and hold investor, invested for the long term, month in, month out, so you can capture the returns that happen on those days. Everybody understand that? Questions on it? No? Good. So buy and hold, buy and hold, buy and hold. Couple other comforting facts, because remember I showed you, oh, there've been years where the market's down, up, or whatever. Look at any day, just cherry pick a day or throw a dart at a dartboard from 1926 to 2020 and count forward from that date 1, 5, 10 years, okay? Notice what happens. The longer you're in the market, the better certainty you have that you're going to make money. It's something like anything much over 10 years, which all of you are thinking on this phone call. You're not planning, I hope, to pass away for many, many decades from now. So again, there's no guarantee, but based on history, you have, if you stick with the market, you have essentially 100% chance that you will make money. It's just you get into trouble if in the short term you're trading in and out, because during that period, there's much more risk. So long story short, stay stay fully invested and you'll do fine. And remember the counter to that. The people, only people who get hurt on a roller coaster are the ones who jump off. So ignore the noise. People have been talking for the last 10 years that the market is going to crash. And there will be the day where the market will be down. But as we've seen over the last 100 years, it has always recovered and then some. The market's at an all-time high now. Just ignore the noise, invest regularly when you have the savings out of each and every paycheck, and you'll be fine. Oops, hold on. Okay, so brief recap, we've talked about risk and return. You can't get one without the other. We've talked about stocks and bonds and how they fit into the toolbox, why you should only look at mutual funds for their diversification. Now we're going to look at 4 other questions. How do I choose the company to invest my money? I don't mean Apple or Tesla. I mean Wells Fargo or Fidelity, or where do you choose the company where you will house your investments? Then we're going to talk about what mutual funds I suggest that you buy. And to also talk about Ruth's question. How much money, how should I allocate my money across those 3 buckets of stocks, bonds, and cash? And then what kinds of accounts I should use for those investments. Just to give you a heads up, I'm sure you've heard of the term 401ks and IRAs and taxable accounts. We're going to talk about those things as houses to house the various mutual funds that you would invest in. I promise this will all become clear in a moment, but first we're going to talk about the company. There are tons of companies out there that offer mutual funds, just to let you know that. If it were me, again, I'm giving you my free advice. It is yours there to follow or ignore. I'm going to suggest that you look for a company that's big, trusted, has low costs, so they don't take much of your money for managing it, and that is owned by us as investors, as opposed to owned by outside people. I'll explain in a minute why that's important, but let's click through what I mean by each of these, and why I think of all the companies that are out there, my recommendation is that you put your money at Vanguard. It's where 100% of my money is, 100% of my family's money. And as I indicated in session number 1, I make absolutely 0% anything, whether you go with Vanguard or not. You should feel free to invest wherever you want, but I owe it to you to explain why I think they are a wise choice. First, they are humongous. They are $7 trillion in assets. You've all heard about the big Build Back Better plan that's going to be somewhere around 1.7 trillion. Imagine the Vanguard company is 4 times the size of the Build Back Better plan. So it's huge. In fact, they're one of the largest investing companies in the world. Second, it's not just me there. They are extremely trusted by millions and millions of people. They have over 30 million families, just like yours and mine, who've invested there. And here is an amazing statistic just to show you how the world is stampeding to the Vanguard's door. Of all new money going into the market every year that could be acquired by hundreds and hundreds of companies out there, over half of all money is going into Vanguard. Think about that. People are voting in droves with their pocketbook. Over half of it is going to Vanguard, and the hundreds and hundreds of companies that compete with Vanguard are trying to get the remaining 40-some%. So I think that says a lot too. Next, they are very inexpensive. Now, be aware that a company can't work for free. In order to set up the mutual funds and administer them, they have to charge us something to do that. And that thing is called a management fee. But take a look at this. What Vanguard charges us to invest our money with them is 82% less than what the other firms charge on average. So to show you how little they take from our investment, out of every $1,000 you have invested, and it depends on the fund, but they take anywhere from 40 cents to about $1 out of $1,000. That's basically next to nothing, right? The other companies charge 4 times that on average. So think about it. Would you rather pay a fee 4 times what you're paying, or 1/4? You'd rather pay a very low fee. So by investing with Vanguard, more of your money stays in your pocket rather than going to the investment house. Corollary to that, their funds do not have any commissions or what are called loads. A lot of companies have that. And I'll just, without spending a lot of time on it today, do not repeat, do not, with 12 more do nots, invest in any kind of loaded funds. You should be paying 0 commissions to buy and sell. And that's what Vanguard sells. Finally, this is a very unique point. Vanguard is the only company in the world, an investment company, who is owned not by fancy executives in corner offices, but is owned by us as an investor. The mutual funds we own, in turn, own Vanguard. And so we are conscious of the way our money is being spent. And so, as an example, I will get a letter once a year or so from Vanguard saying that we have so much new money coming in that we are able to spread our expenses out, and that 40 cents that you were charged last year is dropping to 39 cents. So imagine the company you're investing with is coming to you saying, we are lowering the costs that we were charging you. Like, what other companies do any of us deal with where they tell us we're going to charge you less next year? Well, that's the advantage of being an owner at Vanguard that you don't have with any other company. Okay, so we've established a background on how to choose an investment company. Now we're going to drill down a little further into the actual funds that I would consider investing in if it were me. Just like there's hundreds of investing companies, there are thousands of mutual funds out there. It would drive yourself crazy trying to pick between them. But I promised throughout these presentations to keep this simple. This is not just my recommendation. Vanguard believes that you can have a wonderful, wonderful portfolio with very broad diversification with just 4 funds. So think about that. You don't have to try to pick dozens and dozens of stocks or hundreds of bonds. You just buy 4 funds and they can handle your entire life investment. That's also parenthetically why I've told you from the beginning here that this is a program where you don't have to hire a fancy financial manager who's going to charge you hundreds or thousands of dollars a year to manage your account. Because when you hear that I can do it all, or you can do it all with 4 funds, you'd say, well, I can certainly learn about 4 funds. I don't need to pay anybody to babysit me on this. And that's what we're going to be talking about over the next couple of minutes. So these 4 funds, very easy to manage. And because I had to give you names, I'm going to be giving you names of Vanguard funds. You can find similar funds at other companies, but that's the example we're going to use today. But your first order of business, if you're out of debt, this is a big if. Remember, this investing only starts when you're out of debt. If you're blessed with your current money situation being there, then you first have to decide, and this is not for company money through your 401k or something, but if you're able to have an IRA or individual investing, which we'll talk about a bit later, you need to figure out where you're going to house them. And so that's what this little tool is there for. Choose Vanguard, choose wherever you want to invest, but pick a company where you're going to be making your investments. Now, I said 4 mutual funds, and when I say broad diversification, this chart will prove it too. You're going to have first across those 2 asset buckets, bonds and stocks. Second, geography, both the United States and non-United States, and different kinds of markets outside of the country. It's called developed markets. Developed markets means like America, economies that have been going well forever, places like Germany and Japan. And then what are called emerging markets, places like China and India and Africa. So you'll be all over the world with both companies and governments, because governments offer bonds just like companies do, and then small, medium, and large groups of companies. Why is this so important? Back to that thing about diversification. In any given year, it's impossible to predict if big companies are going to beat medium or they're going to beat small. Or is the United States going to beat international, or is international going to beat the United States? So for the same reason that you don't pick individual stocks and bonds, it's very important to pick a broad diversification of stocks and bonds. So whatever area is up, that you're taking advantage of that. And conversely, whatever area is down, you don't have all your money in that. And by the way, that gets back to Ruth's question, which again, we'll handle more in a moment. But my recommendation is very, very broadly diversified funds in stocks and bonds. Oops.
Hey,
Now-
Bruce, can I ask real quick, just
Yeah.
because I noticed that probably around half of the people on this call right now are not in the United States. Is the investing with Vanguard all the same across the board, no matter where you live?
What you're saying,
There's no restrictions if you don't live in the US to invest in Vanguard, right?
That's an excellent question. You will find with me where I'm really conversant with the answers, I'll tell you, and when I'm not, I'll say I'm not sure. We are in that category now. I think I'm not sure, but the principles are the same. If you find, for the half of you that are not in the US, I would contact Vanguard and see if you're able to buy their funds as a non-citizen of the US. If the answer is yes, you have no problem. If the answer is no, this session today will still be valuable because you can buy, I would encourage you to buy similar funds in your home country that invest in the US, and it'll just be a different definition. You'd be buying the US as an international fund, right? Because you're not located in that country. But excellent question.
Thanks.
Sure. Okay. So Ruth talked about having, are there different kinds of funds that you can invest in and what they invest in? And the answer is absolutely yes. Okay. As she asked or alluded to, you can invest just in green companies. You can invest in a tech mutual fund that only invests in tech. You can invest in mutual funds that only invest in medical, and so on and so on. That's why there's 5,000 different funds out there. I'm going to recommend you not do that. And again, why is that? I keep coming back to diversification. When you invest in a tech fund, you are explicitly saying that you have a crystal ball where tech is going to perform year in and year out better than the market in general. And you may think that, but you have no basis on which to say that. So I wouldn't look, if it were me, at any narrowly defined fund. I would only be looking at what are called index funds that are broad funds. I'll explain what the index is in a minute. Broad funds to give you maximum diversification. Remember, I said there are 4 funds, 2 in the US, 2 outside of the US, a stock and a bond, and that's 4 total, right? 2 stock funds, 2 bond funds. And these index funds, if you see here in the second bullet point, Vanguard builds each basket to mirror or ape or echo what is going on in the overall market. So for example, when you're in the total stock market index fund in America, the US market is roughly, I think it's, these are rough, 60% big companies, 30% middle-sized companies, and 10% small companies, 60, 30, 10. You'd go crazy buying the 5,000 stocks that are in those that represent that. Vanguard puts together an index that is 60% big, 30% middle, and 10% small. So with that one fund, you're getting the blend of what the overall US market is. Similarly, internationally, if those developed markets represent 70% of the world business, the countries like Germany and Canada and Japan are 70% of the world business, and 30% is in those smaller emerging markets like Africa, China, and India, then the international fund will be 70% in those big developed countries and 30% in the emerging. And so that's the way the indexes work for all 4 of these. So when you're done, you would wind up with a US stock fund, the total stock market, and a total international. And on the bond side, a total bond fund and a total international. And these sound generic. These are literally the names of the funds. if you decided to go with what I'm recommending, you would buy these specific funds. Once again, like when I quoted Warren Buffett up front, this is not just my recommendation. You'll remember this icon from our first presentation about where you get tools online. When you click on this link, when you're back at home off the session, there will be an article where Vanguard talks about how you can have an amazingly simple, terrific investment program with simply these 4 funds. And when you look it up, you pull up the article, you will see these identical 4 funds named. And as I said earlier, this is where my family and I have our money. Okay. Questions on this? Anything before I go on? All right. So just one other quick curveball to throw you. The mutual funds I've just talked about each require $3,000 to open an account. But don't get panicked by that. If you don't have $3,000, which I'm sure many of us don't, they have an alternate investment called an ETF. That's an abbreviation for exchange traded fund. Consider it just like a mutual fund. It works. It'll have the same return as the 4 funds I just talked about. The only difference is it's much cheaper to make the initial investment. They only require a single share of the mutual fund. It varies day to day what the share costs, but it's somewhere between $50 and $150. So if you have a very, very modest amount to start, don't fret that, oh my gosh, I have to save up to have $3,000 for a fund. You don't. You can get started with as little as $50 or $150. And so here's kind of the way to look at it. If you have at least $3,000 to put into a fund, you can buy the mutual fund or the ETF. The ETF expense ratio, that 40 cents that I showed you, is actually a tiny, tiny bit cheaper than the mutual fund. So if you really, really want to look at the cheapest cost, look at the ETFs no matter how much money you have. And obviously, if you have less than $3,000, you have to invest in the ETF. But to keep it simple, to not have to keep using those same terms throughout the presentation, just anytime I use the word mutual fund, in your head, substitute, oh yeah, or the ETF version. And if you were to call Vanguard and name those 4 funds that I just named, you just say, I want to buy the ETF version of those 4 funds.
So Bruce, it seems like the minimum is less on the ETF and the charge is less on the ETF. So why
Yes.
buy a mutual fund?
Yeah, very good question. Excellent question. A couple reasons. The first is what I'll call inertia, which doesn't apply to you. My life savings is in the mutual funds because these ETFs didn't exist until a couple years ago. And I'm basically, the thought of having to go through and transfer all the money to save that one tiny little penny, I haven't done it. The other reason, the only downside of an ETF is, well, compared to a mutual fund, remember we talked earlier that a mutual fund makes money when it pays its capital, when it pays a dividend or interest, or if it goes up in price and they sell it and you make money that way. When that happens on a mutual fund, you can tell Vanguard or wherever you are to automatically reinvest the money in your account as opposed to take it to spend it, if you so choose. With an ETF, the money goes into a cash account and you have to manually go in and say reinvest. Now, for most people, that's not a big deal. I'm just kind of lazy, to be blunt about it, and I like the automatic reinvest feature. But that's the one thing with an ETF, that if you want to, and it's in a retirement plan where you shouldn't be taking it out right now, to reinvest, you have to tell them, okay, now buy the extra shares with the money I just made on the dividend or interest. But great question. But in terms of performance, when you look at it over the course of the year, they move in lockstep with each other.
Thank you.
Okay. Remember I said earlier that if for the sensible investor, it makes sense to have some money in stock, mutual funds, some in bonds, and some in cash. This is a little not tricky. I guess the word is, the account needs to be tailored to you as an individual. I can't sit here, nor would I ever try and tell you, you should have X% in stock mutual funds and Y% in bond mutual funds. There is no one size fits all, but your split, and the fancy name for this is asset allocation. That's a fancy name for how much do I want in the stock bucket and how much do I want in the bond bucket, will be based on your unique situation, which we'll talk about in a moment. Again, I have a couple slides here where I say this is very important, like being a buy and hold investor. This is really, really, really important. How you decide, not even which mutual funds you buy, but simply how much you have in stock and how much you have in bonds will predict 90% of what will happen with your money. In other words, this decision, how much in stocks and how much in bonds, is the most important decision you will make. And so it's something you need to do very carefully. Happily, when I said Vanguard isn't going to tell you how to do it, and I won't tell you how to do it, there is a very simple tool that you can use to objectively decide what to do. But first, I'll explain how the tool works. In general, you want to be more aggressive and take on more risk and have more money in stocks if you can answer yes to some or all of these things. Am I younger and further from retirement? Do I have the discipline to not panic and sell when the market's down? I've pleaded with you not to do that. I won't be there when the market drops to tell you, remember, you're not supposed to be selling. And a higher percent in stocks and bonds if your income is very regular and stable and growing. On the other side, you might consider having a higher percentage in bonds when the opposite of this is true. You're older and closer to retirement. No matter what I tell you, you're going to panic and sell if the market's going to go down. And your income is in and out, you're part-time, you're freelance, you don't know if your company's going to be there tomorrow. So just in general terms, this is how to kind of tilt your portfolio. If you can honestly say you're in this top group, you should have more in stocks. If you're in this bottom group, more in bonds. And now here's the tool that will help you decide. Again, you'll see these little icons here. This will take you 5 minutes to make the most important financial decision you will make. Go to this investor questionnaire. It's on Vanguard. It will ask you 11 questions. You answer the questions, and then the computer will diagnose how risky a person you are, how much risk you're willing to take. And because the range is from 100% stock to zero or 100% bonds to zero, it will come back to you with a suggested split of how to split your money, which is a very nice objective way to decide how much risk you're willing to take. Now, this is a very important caveat, this one down here. Note, if the tool asks you about something you haven't done before, answer based on what you think you would have done after taking this course. So since most of you haven't been investing, and it asks you what you did in 2008 when the market dropped, you have to look at the question and say, okay, I've learned today I shouldn't panic and sell. And then the other answers will be, I would have just held what I had, or I would have bought more, looking on it as an opportunity to buy when the market's down. And so just answer the 11 questions, and it will give you a suggested split between stocks and bonds in 10% increments. Okay, but very important. Write this down, page 23. It'll be in our wrap-up slide at the end. You must do this, as opposed to, I beg of you, don't just take money, whether you invest in these 4 mutual funds or not. Don't just take your money and start buying stuff. First step, decide how you're going to split. And in the rest of this meeting, I'm going to show you an example of how we use this questionnaire for an example person that you can work through on your own with your own numbers. Okay. So I'm going to pretend somebody took the questionnaire and they were younger. They said they wouldn't panic. Their income's pretty stable. And the computer said that they should be considering an 80% stock, 20% bond portfolio. So that's what we're going to be using today. But again, I keep beating this to death. When you're at home, you take the questionnaire and use the percent that fits you when you're ready to invest. But I had to do something on the chart, so I'm going to be using the 80-20 thing. But remember also, we're not doing anything with the market until we're out of debt. We're going to get rid of our debt first, and then we're going to start taking what we save after that to put it into the market, which I hope we're all clear on. Debt payment first, then invest in the market. Okay, as we go through these numbers, I told you all to please bring paper and pen and paper with you today. If you're already out of debt, as we go through these numbers, you can privately on, the safety of your own home, plug in your own savings numbers. If you're in debt and have no savings, just follow along with the numbers I'm going to show you here. And then later, you're going to have a soft copy of the slideshow. When you're home on your own later, you can go back and refer to this and go back now that you have your own savings and put your numbers in that. But for now, if you're still in that category of not having it, at least walk through with the numbers I'm going to share with you. So 5 steps to this to actually start putting this money into the market. First step you've already done if you've done your homework from the last session and the homework I said afterwards to review it. What is my current money situation? We add up all the money we have, right? And in the example I'm going to give you today, this particular person has $42,000 in savings. So the first thing you're going to do is, if you have your own savings, privately write that number down on the top of a piece of paper. The rest of you just follow along. So we got $42,000 in savings. Now, you may be thinking, okay, so Bruce is telling me I should take all that money and invest in the stocks and bonds. That's not what I'm going to tell you. There's a subtle difference. Why is that? First thing you need to do is take that total savings. Remember, I mentioned the word emergency fund when we were talking about cash in the toolbox. We're going to split the total money you have into an emergency fund and into money you can invest, the investable savings. So as a good rule of thumb, you want to keep about 3 to 6 months of expenses for emergencies. Okay, this is beyond what you have in your paycheck to pay for this month's expenses. So you want to save up enough that money's in there, not in stocks or bonds, because remember, we're holding those for the long term. You want this in a checking or saving or CD account where you can get to it tomorrow if you needed it. And so you're going to compute your emergency fund of 3 to 6 months, look at your monthly budget, multiply that number by 3, 4, 5, or 6. And then we're going to subtract that from the total savings. And what you have left is what you can invest. And so I'll show you with the example of what we're doing here. This person that we're looking at, they're spending about $3,000 a month. They decided that they felt comfortable with a 4-month emergency fund. So they took 4 times 3 is 12,000 for emergencies. Remember, their total savings is 42,000. So they took the 12, subtracted it from 42, which means once they have the emergency fund aside, they have $30,000 to invest. So again, on your side, for those of you who have savings, or even if you don't, start thinking about whether you'd want to have 3, 4, 5, 6 months put aside when you do have it. So look at your monthly expenses, multiply by a number between 3 and 6. And for those of you who have it, earmark that for emergency. For the rest of you, think about how I'm going to save that out of tightening my budget over the next X months so I have that emergency fund. So again, we're going to go to this example here. Here's where this person took the 4 months and subtracted 12. Everything else is now something they're thinking about investing, right? So everybody take a moment who has some savings, do the same thing on your own chart using your own money. And then we will talk about, okay, now how do we divide this 30,000 among the mutual funds that we were talking about? Again, I forgot to show you this. Remember, emergency fund in an account you can get to tomorrow. Checking, savings, money market account, a CD, certificate of deposit, something that's immediately spendable if you have an emergency. Okay, now, remember I said we're going to take that little allocation, that questionnaire, and we're going to divide our money into 2 big buckets, how much goes into stock and how much goes into bonds. This person, remember I said they took the questionnaire, it said 80% stocks and 20% bonds. And let's, for now, because you haven't taken the questionnaire, do the same with what you have in your investable savings. Split it 80-20, but then ignore that before you actually do any investing. When you get home, do the questionnaire and change the split to what the computer says your split should be. So here's what happens with this person. Remember I said they're 80-20. So they have 20% of their money in the bond side, 80% of their money in the stock side. And here's how the math works. 0.8 times 30 is 24,000, and 20% of 30 is 6,000. So that's how they've divided their money. Oops. Sorry. So everybody got that. But again, you're going to do it with your savings, whatever you have here, divide it 80-20 for now. But remember I said there's two stock funds and 2 bond funds. So we're now going to look at how we take this stock money and divide it between US and international. And then we're going to look at the bond side and how we divide the bond side into US and international. We'll start with the stock side. On this thing, there is no right answer. Vanguard won't give it to you. I can't give it to you. It's something you're going to have to decide on your own. But you'll see I've highlighted it here on slides 36 and 38. Vanguard gives you general guidelines on how to split your money between the US and overseas. And about all I can tell you is what we used to call the tummy test. Just ask yourselves how comfortable you are investing in the US versus internationally, and let that help you, guide you. A couple things just to think about as you do that though. I'm guessing if you're like me, or most of us, we tend to think, oh, we live in the US, we understand America. I feel safer investing in America than in international. Something to keep in mind while you're thinking that. First, the US, while we are a dominant country in the world, we are less than 50% of the total stock market in the world and less than 50% of the total bond market in the world. So when I talked before about the importance of diversification and being everywhere, you're eliminating the majority of the investment opportunities in the world if you just concentrate on the US. Second point, you have no idea in a given year whether the US is going to be up more, less, or same as the rest of the world. For the same reason you want a diversified stock and bond portfolio within the types of stocks and bonds that they buy, you also want to have a diversified portfolio in terms of what countries they are in, which is why I strongly recommend you follow Vanguard's advice and have some money in the US and some money in international. And so we'll start with the stock one. Remember I said Vanguard won't tell you what to do, but they think that for the stock bucket, you want to be somewhere between 50% US and 50 overseas, and 70% US and 30% overseas. This person that took this survey decided to split the difference, and in the chart I'm about to show you, they decided to go 60-40, 60% US, 40% international. So I'm going to ask you today to do the same thing for your stock bucket. Use the same 60-40, but then later think about the range where you'd want to be in this range. Okay, but let's show you what it looks like with the 60-40. So here you can see what happens. The 24,000 got split into 60%, 14.4 US, 40% international, 9.6. And you'll remember the names of the funds. They put 14.4 in the Vanguard total stock market, which is America, and then 9,600 in the Vanguard total international stock. Everybody tracking with me so far? I know a lot of numbers, but remember, it's only 4 funds. We can get through this. All right, we're going to do the same thing now on the bond side. Here are Vanguard's rough allocations on the bond side. They think we should be somewhere between 50% US, 50 international, and 80 US, 20 international. This person decided to be a little closer to the US number. They chose to be 60-40. Excuse me, I'm sorry. They chose to be, there's a typo. Actually, 60-40 is the middle point. They chose 50-50. Okay, 50-50. So that's what we're going to use on this chart. That's what I'll ask you to use as well, but change the percent when you get home. So again, 50-50, the math is easy, 3,000 and 3,000. And then you'll see they have 50% in the total bond US and 50% in the total international. And then when you take all these numbers, these three numbers here, this is what their overall investment thing would look like. 14,400 is 48% of $30,000. This will become important when you're actually investing your money. Once you do this chart and you decide where you're going to invest, and if you like these 4 mutual funds and you do your splits here, you will simply call the company that you're going to invest in and say, look, I want to buy these funds and I want to split my money in these percentages. Okay, but your whole life savings, everything is distilled down into 4 simple funds that will be easy for you to track. Okay, think of what you just accomplished. You've done a fantastic investment plan with 4 funds that Vanguard thinks is all you need to do and all I think you need to do. Remember I said we're going to keep this easy, so I hope we've done that. The next step is actually implementing, taking the money that you have, once you have money to invest, and actually putting it into one of the companies that you're going to go to. And so we're going to talk about doing it, but first, remember, you put the emergency fund aside, and then you take the investable savings and you start putting them into the market and we haven't talked about this yet, but this is important for you to understand the difference between your investment and the structure of the investment. Just kind of a show of hands, have all of you heard of a 401k and an IRA? Can we just see how people, if they're familiar with those terms? What's the answer, Jamie?
Oh, I'm sorry. I didn't know. I'm thinking everyone. Looks like about half are.
Okay, so I'll make sure everybody understands what this means. Look on it. I'm going to give you an analogy of back to real estate for the person who asked about real estate. Look on the mutual funds we've been talking about as furniture inside a house. Okay, you have different pieces of furniture. You have 4 pieces of furniture. You have 4 mutual funds. The account you put it in, the 401k and an IRA or whatever, which I'll talk about in a second, consider that the house that holds the mutual funds. Okay, so a 401k or an IRA aren't investments. They are a house that holds the various investments that you would make. And let's talk about each of them so you know what they are. 401k is a company retirement plan offered through your work. And you'll see here, I talk about the advantages of each of these kinds of plans, where a yes in green, that means really good, and the no doesn't mean bad, it just means it doesn't have the green yes. So what's neat about a 401k plan at work? It gets 2 yes votes. First of all, it gets free money if your company offers a match. For those of you who have a 401k at work or want to learn about it, most companies have a thing where if you put aside $1, the company will put on top of that dollar 25 cents or 50 cents, or if you're really lucky, $1. So you just earned a ton of money just by being part of the plan. So that's why being in a 401k plan is a really, really good idea if your company offers it. It's also, depending on which kind of 401k you're in, it's tax-free or tax-deferred. That's a huge yes as well, because you don't want to pay taxes today. You'd rather have the taxes, never have taxes, or have taxes in the future. An IRA is a personal individual retirement account. It's where you put aside money for yourself. Now you notice it gets a no on free money because you're putting aside your own money. So there's nothing free. But depending on how you set it up, it gets a yes on the tax-free or tax-deferred, which is really good. Only after you have a 401k and an IRA, you should consider taking the rest of the money that you have and investing it in what's called a taxable account. You just open a regular account at, say, a Vanguard. The money in that doesn't get matched. It doesn't earn money tax-free, but it does grow over time until you sell the account. So it's way better than putting, that's what we've been talking about. This, for most people, having these 2 things are the things they start with, but when they have free extra cash, they invest outside of their IRA and outside of their 401k. But so I'm doing this chart to show you the priorities. If it were me, your first order of business, if your company offers it, open a 401k at work and take advantage of any free money. If you still have money left after the 401k, you can open an IRA with up to $6,000 a year or $7,000 if you're over 50. And by the way, if you're freelancer, don't work at a place that has a 401k, this IRA, priority 2, becomes priority number 1. Put aside, if you can't afford 6,000, you put aside 500 or 1,000, whatever you can do a year in the IRA. And then once you have maxed out the IRA, then you consider putting money in a taxable account. Now, I said there's two, I alluded to the fact that there are different kinds of IRAs and 401ks. That's what this chart shows. And just hang with me. It's showing that there are 2 different kinds of 401ks and IRAs, a Roth and a traditional. You notice the Roth gets 2 yeses and the traditional only gets 1. With a Roth, all the money you take out is tax-free when you retire, and you don't have to take money out beginning at 72. The traditional is the opposite of that. When you take the money out, you have to pay tax, and you have to start taking money out at 72. The big difference is up front also. On a Roth, you don't get a tax deduction up front. So if you put aside $100 in a Roth, you had to pay tax to get you to the $100. But then if that 100 grows to $500 over your lifetime, all 500 comes out tax-free. On the traditional side, if you put aside $100 in an IRA, you get a $100 deduction on your income. So your taxes dropped by a couple dollars. That's the good news. But the bad news is when you take the money out, if that 100 builds up to $500 over your lifetime, when you take it out, it's all taxable. Again, to keep this simple, for most people in most circumstances, if you have a choice between a Roth and a traditional, open a Roth account for the mutual funds we've been talking about. If you work at a company, some companies offer both a Roth and a traditional 401k, go with the Roth. If they only offer the traditional, you have to go with that. But that's still better than having the money get taxed.
So Bruce, I just heard last night that that as of the end of the year, you cannot, or after the end of the year, you can't transfer an IRA to a Roth, but you still can right now. Is that something that you advise?
Okay, let's see. I'm not at all sure that you heard that correctly. As far as I know, there has been no law change that prevents you to be able to convert a traditional to a Roth at all. And that wasn't even on the table. I'm not, so I.
Okay, so scratch that. What are your thoughts on, if you have $1,000 in an IRA?
Yes.
It's been sitting there for years.
Yes.
Do you feel like there's value in moving that at whatever stage you're at in your investment?
Yes.
Moving it to a Roth.
Yeah, that's a great question. We're back kind of in the category of where I'm not the expert because I'm not a CPA or an accountant. Let me give you the general answer on that, but I would urge anybody who's considering that, talk to their tax person or talk to the people at Vanguard or wherever they invest. Generally speaking, the younger you are, the more it makes sense to do the conversion. Because what Jamie is alluding to is when you convert to the Roth, you have to pay tax. So you're going to have a little bit of a hit. If you've done it when you're young and there's not much in the account, it doesn't cost as much as if you do it when you're older. And you also have, when you're younger, you have more years for the account to build up, right? Because you have more years to work and more years in retirement. I'll just give you myself. I only had a traditional IRA during my lifetime. That's it. And by the time I quit work and retired, I thought it was too old for me to pay all the tax now. I'm just going to keep it as a traditional. Okay. But if I were 20 years old, and just let me put it this way, if I were 20 years old or 25 or 30, had a 401k at work or a traditional 401k that I could roll into a Roth IRA, I would have done it at that age. As you get in between, it gets harder to decide. But I'd say talk to a professional on the taxes but my point now is, for somebody setting up an account today, which most of you are in that category, you haven't been saving much, or you're starting to save now, I would go with a Roth now for most of you. Okay.
Thanks.
Is that clear?
Yeah, thank you.
Sure. Okay. So now practically, for those, if anybody on the phone has a 401k at work and you like the program I just showed you, I would call your plan administrator, tell them I want to swap all my accounts and put my money into these mutual funds using the split that remember I showed you that split at the bottom of the chart. Remember this, the 48-32, whatever it happens to be for you. So you would call your company and say, look, I want to move my money into those accounts, into those 4 mutual funds. And I want to, make all new contributions in that same split. There's a decent chance that your company will only have some of the mutual funds that I mentioned on this chart. Don't get freaked by that. Just work with the plan administrator to say, okay, I want to have something in the US and something international in both bonds and stocks. What do we have that's similar? And you can do it that way. So that's on the 401k. You don't get to pick the company where you're invested in your 401k because your company chose what house to put your investments in. But remember, on your IRA or your number 3, your personal money, you can invest wherever you want. So that's your homework. You have to go pick a company, like I put earlier in the thing, pick somebody like a Vanguard, and then call them and invest in the same thing, whether it's ETFs or the mutual fund equivalent, the same way you did, in the same ratio from what you did in number 1. And then if any of you has any money beyond that, you open a personal taxable account, because it's still important to save as much as you can. I would invest at the same company that you chose for your IRA, because it doesn't make sense to put some money at Vanguard and some money at somewhere else. Like, pick one company so it's all in one place. And again, keeping it simple, use the same ratio across the same 4 mutual funds.
Bruce, I'm sorry to keep asking.
Sure.
questions of you.
Go ahead.
So is it not a risk to be putting all of your eggs in Vanguard?
The short answer is no. You are insured for, I think it's $20 million or something federally, and the money's really not held by Vanguard. It's escrowed, so I wouldn't worry about it at all. All the companies have, it's very complicated, but there's 2 kinds of insurance that kick in, and being with, it's one thing if you were invested with an individual person who pulled a Bernie Madoff or something, but I wouldn't worry about it at all. You are protected.
Thanks.
Yep. Okay. Summary about what you've learned today. Actually, let me do, whoops. Hold on. For my computer. This is what you've learned about, I hope. You've learned how to get out of debt quickly following the 8 steps. You've learned to spend responsibly, learning the difference between needs and wants. You've learned to save with the 8, again, with the 8 steps, paying yourself first, doing a monthly budget, getting off a credit card, right? Pinky swear to the financial freedom stuff, financial freedom pledge. You've learned how to invest wisely with simply 4 mutual funds. We haven't really talked about this, but I have this as a point too. Giving generously, people like Jamie has now dedicated his life to CPP, and how generous he is of spirit of giving both his time and talent. When I say giving here, it doesn't necessarily mean that you have to give money to those less fortunate around us, but I encourage all of us, because it is so wonderful to pay it forward to people that need help. If you have some time to donate to a group, if you have some talent to donate, or when and if you have money that you can do comfortably, it's a great way to help the world around us. So I hope people will consider that down the road. Like I said, give yourselves a big hand. You've sat through 2 sessions with me.
Mhm.
You've been great students. You've learned how to save, invest, and dream for what I hope is the best financial freedom of all, which is your own. Oops, somehow we'll fix that, but we've got 2 pieces, well, 1 piece of homework, and then what you can expect after the session, and then we can open up for questions. Here's your homework, and we've talked about it as we went through the slideshow. First, if you have money to invest, you got to go pick a company to do that, and then we explain on those 13 to 15 why Vanguard seems to check all the boxes. Please, please, please do the questionnaire to decide on the best way to allocate your money across stocks and bonds based on how much risk you feel comfortable taking. Then the meat of the thing is actually implementing the plan. All that flow chart page, it shows how the money cascades down from your total savings to investable savings to bonds and stocks to 2 bonds and 2 stocks. I want you to do that, and then get on the phone and start making it happen by investing, both if you're at a company plan or in your own personal IRA or taxable account. And again, don't worry about having to have memorized all this. In the follow-up letter that will come out, or email from Jamie and me, we will give you the link to the materials you got today, just like you did after session 1. But what's next is very similar to what happened after session 1. I continue to want you to feel that you are not alone. People are already starting to book times with me for private sessions. So I urge you, as you go through these materials, where you go, it made sense on the phone, but on the first session, but I got lost. What did you mean by this? Or I want to bring up some personal financial stuff that I felt uncomfortable bringing up in a bigger group. Please go to book a time, schedule a no cost private meeting with me. I'll answer any questions that you have. And then one last thing before we take questions, your feedback is very important to me. And so we've put together a 10-minute course survey. It's just a quick, check boxes and a couple places where you can write a comment or 2. Please, please, please fill that out so I can help make the next class that I have even better than this one. So please do that. And then lastly, I want to spread the word. As I said, I'm in retirement now. I want to help as many people as I can. So if you have friends or family or coworkers or anybody you meet who you think could benefit from this, you've got my email. It'll be in here again, brucedale@gmail.com. Just refer them to me. And you can also be an honest spokesperson where you can go to them and say, the guy promised there was no cost, and I've been through literally multiple hours with him, and he's legit. He doesn't charge a single thing. He just wants to help. So with that, again, thank you for your attention, and I will take any questions anybody has on anything.
So real quick, one thing I just want to also mention, I see Tom is still here, but he was saying, and I guess he really stuck it out, because Tom is in Germany and he said he had to leave a half an hour into it.
Yes.
But I see you're still here, Tom. So I'm not
Bravo
sure.
to you. You get the award for the farthest travel, Tom.
I'm not sure that he does, but
Oh.
I think we have a few in Europe.
Okay.
He also sent a note, which I thought was worth repeating to you. Let me just find that. He says, he's quoting the Dalai Lama, and he says, share your knowledge. Sharing your knowledge is a way to achieve immortality.
Oh, wow. That's beautiful. I hope it's true. You guys will remember me, I hope. You'll look back on these sessions in 2021 and say, it helped put you on the road to freedom. I will feel immortal if that happens. So thank you. So questions, anybody?
Thank you so much, Bruce. This is super helpful.
You're most welcome. Again, you've been very attentive, sticking with us for 2 sessions. Bravo to you. And I look forward to re-meeting some of you on Zoom if you want to put up with me on more private meetings to talk about anything you want to talk about.